In this week's update, insane volatility and how to deal with it. What's it going to take for this bearish phase to be over? And it's all about effective positioning and patience. My name is Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. What a crazy week, particularly Thursday and Friday to finish. The market going abruptly in both directions. It's pretty hard to figure out the drivers behind that sort of price action. We're still in a bear market, but don't switch off because opportunities are there now, and more and more opportunities will come into focus as well. Some stocks are doing great, so get a plan for them. There's hardly anyone that I know who trades or invests in the index. People are stock pickers. So why not just focus on the stocks that are doing really well rather than some generic sort of formula that conventional thinking says you should own? A bit of this and a bit of that. The bottom in general stocks, and this is just the way that the market works coming out of every bear market, the bottom in general stocks will be a couple of quarters ahead of the data. So, potentially 4 to 6 to 8 months ahead. So if you're waiting for the data to get better, then you're going to have well and truly missed the boat. You need to follow what the money flows say, not the logic, not the economic fundamentals. Now, at the moment, a bit of the logic is working out because we're still in downtrend, but the logic will cease to work when the market turns, and the very best opportunities will get missed. Thursday and Friday were just absolutely crazy. We had an inflation number, the CPI number, which came in hotter than expected. The market reacted badly, as you would expect, gapped down significantly, and then immediately turned up and ended up in an extraordinary rally, closed right on the highs, and it sort of completely defied what you would normally expect. And then on Friday, it was like as though Thursday never happened, and the market immediately then turned back down again and closed on its lows. And nearly every stock in the US not only closed down, but closed down on its lows as well. So the selling went right to the end. The one thing that I would observe is that there were massive reversal candles on Thursday, but this was, and that occurred across so many stocks, but this was not confirmed by the sector money flows. So that was sort of the warning sign to me not to get taken in by what happened on Thursday. So let's take a look at a couple of charts just so that I can illustrate what I mean. And this first chart, I've just put the indices and some stocks just randomly, that popped to mind to illustrate my point. So right down the bottom, we've got the QQQ, which is the NASDAQ. That's the NASDAQ ETF. And this is over the last 12 months. So you can see that from a common starting point, the NASDAQ has fallen, and it's done worse than the next chart, which is the XJO, which is the ASX 200, which is down slightly, but has outperformed the US tech index significantly. Doing slightly better than the Australian market is Apple, despite the recent big falls. And then as we move up the line, we get to BHP, and then Boss Energy in uranium, and nothing in particular about the selections. These are just stocks that popped into my mind. And then if we look in the lithium nickel space, we've got IGO, and you can just see the incredible outperformance of IGO versus indices in the States. So let's not get hung up on whether we're in a bull market or a bear market. The important thing is just go where the opportunities are is the key message. Now, getting back to this insane volatility, Apple, the chart of Apple probably sums it up as good as any. You can see that Apple was in downtrend. On Thursday morning, the price gapped down significantly, and then immediately, traded up very robustly. And if you take Friday out of action, you would look at that on elevated volume and say, this is the world's best reversal candle that you've ever seen. But the problem was that if you look at the US Treasuries, the 10-year yield at the time, so this is Thursday night. So initially the yield spiked enormously, which is what you'd expect, to over 4, and the market sold off. Treasuries then came down a little bit from over 4, but only down to 3.9, but stocks rallied to an extraordinary degree. So, I was expecting to see the 10-year Treasury down at 3.7 or something of that nature. So I looked at this, and I would place more weight in what the bond market is telling me than what the equities market is telling me. And so I just didn't believe the rally on Thursday night, and roll into Friday, so it is. And the yield spiked back up to just over 4. Let's just look at a couple of other charts to reinforce the point. This is Albemarle, the world's biggest lithium stock. Very similar pattern. We had a sharp sell-off on Wednesday. Have no idea what that's about. Huge reversal candle Thursday, and then of course all back down to normal again on Friday. This is TLT, which is the 20-year Treasury bond ETF. So treasuries are being sold, which is what you'd expect in an inflationary period. You don't want to own treasury bonds. So treasuries are sold, which means the yields go up, and eventually equities went down, but for a period equities went up as well. And in fact, during this decline, equities have gone up a couple of times. So certainly this is really pointing the way. And while ever we've got treasury yields heading down in this fashion, it's going to be difficult for equities to perform. Let's just look at some of the, again, coming back to go where the strength is. Just a quick scan through the US indices. This is the energy sector. The thing to focus on is the red line, the 200-day moving average. Then the shorter term moving averages are above it, and the price of the index is above all three. So clearly still in fairly robust uptrend. But if we look at the other sectors, this is finance, clearly rolled over. This is technology, even more so. Healthcare, not so much, but still really the moving averages are pointing down. And this is consumer discretionary. Again, the bigger picture is it's all rolled over. So it's still looking extremely bearish in the States. All right, now the important thing here is, this is just one of the key reasons that I do this weekend video, and I've been doing it for years and years and years, is to provide a perspective that can help investors with cutting through all the noise. And understanding what's really important and what isn't important. And the most important thing at the moment is that you have a very clear understanding of how you want to operate in the market, or call it your game plan if you like. Because if you don't, if you're not really clear about what you're doing, what stocks you're targeting, how you're going to enter them, how you're going to manage them, then this market going to, about faces like it's doing with this extraordinary volatility is going to absolutely eat you alive. If you don't believe that, then you just haven't been in the market long enough. You haven't been assaulted by the market enough times to understand that that is the case. Now, I just want to touch on what the end of the bear phase will look like. And it will come to a conclusion, quite obviously. Central banks need to offer some hope that the pace of rate rises will start to slow down. The market needs to get a sense that we're near the peak. There certainly are some inflation indicators and some inflation drivers that are showing signs of peaking. So it may not be that far away, but at the moment, the headline and core CPI numbers are are ruling the roost, and they're still looking like fairly poor numbers, and they're giving central banks all the ammunition they need to keep raising rates at the same rate. So we need to see a little bit of hope there. We need to see quality large caps stop falling because they will be the first ones to turn around. We need to see the aggressive sectors starting to gain favour again, and as you'll see when I go through those money flow charts in a minute, the momentum to the downside has certainly picked up again. And then we really need to see some of the inflation indicators need to confirm those changes. So when we start to see those changes, not the CPI numbers, because they're going to be too late, but there's certainly a whole bunch of other indicators that that give us an idea that things are getting less worse, that the rate rises that have occurred so far are actually starting to have an impact. And there is a lag. And that's the danger, as I've been saying all year. The danger was central bank policy error. And they certainly are in danger of making that error, that they keep raising rates, but not giving the rate rises they've already done time to actually reflect. And they could overdo it and push economies into deep recession. That's the danger. So what do investors need to do? Well, first of all, you need to just get organised. And, I'm sorry if you're looking for a quick free lunch in the stock market. It just doesn't exist. There's got to be work done here. You've got to put some effort into it. You've got to sit down and think about it, and you've got to stay on top of it. And, there just isn't a simple, quick fix answer. You've just got to get yourself organised. If you don't want to get yourself organised because you're too busy, then, get someone else to do it for you. Prepare your targets according to your desired portfolio composition. There's absolutely no reason why you can't just sit down, figure out what are the strongest sectors over the medium to long term. So therefore, what your composition of your portfolio wants to look like. Once you've done that, you identify the targets. They become pretty obvious. And then you just, you sit back and wait until they come into your buy zone. Most people just want to wing it because it's easy. You're not restrained by rules and regulations. And what tends to happen is that people don't pull the trigger to get back into the market until things start to look good. The mood's improved. And by that stage, the really good entry points are long gone. Identifying lower risk entries based on where the dips have been over the last 6 to 18 months, just look at the chart, and the chart will give you an idea of where the better low risk entry points are, using dips to moving averages, using dips to support, all those sort of things. This is not rocket science. And then once the price gets down into that zone, it may not be an automatic entry, but at least it gives you a target, and you can start to look harder at the price action once you get down into that zone. So that's the formula. American stocks, they dropped another 1.6% for the week, but if it hadn't been for the abrupt turnaround on Thursday, it would have been worse than that. The volatility was really just quite insane. From my perspective, I think there was an element of short covering on Thursday. You don't tend to get reversals like that without short covering. So, everyone runs to the one side of the boat. The short sellers stop selling and they start buying. Everyone becomes a buyer, and there's very few sellers. I don't know what the trigger was. Doesn't really matter. It just came out of nowhere, lasted one day, perhaps computer algorithm generated, who knows. But then Friday, it just all fell apart again, and what you would expect in equity response happened. So the bond market was right on Thursday in terms of what it was indicating. The bond market wasn't at all impressed by the CPI number. So let's jump into, I'll just put up the rest of this. So US dollar index went up a little bit further. It is in a bit of a period of consolidation, but it's still very strong. the yield back above 4, the VIX above 30, which is a quite extreme level, and the 10-2 spread on yields widened even further. We're almost up to negative 0.5%. So jumping to the charts, if we look at the, let's look at the NASDAQ first of all. So we've clearly rolled over on the NASDAQ. You can see huge gap down Thursday as we looked at before, and then Friday basically unstitched all that. So there's not much doubt that that the NASDAQ is in downtrend. And if we look for potential support levels, the peak in 2020 is obviously one level of support. That is down at around 237. We're currently at 260. So there's still a bit of room for the NASDAQ to fall further yet. Very similar on the S&P. The support level around 3,400 is quite probable. That's this level here. Actually, I'll take that out because I actually wrote that prior to the Friday night session, and that's no longer relevant. So 3,400 is a probable level. You'd have to be very surprised if we didn't get to it. That's this level here. And 3,200 is also possible, and that's about 11% lower on the index, and also corresponds with the 61.8% retracement on the Fibonacci scale. So that's from the lows in 2020 after the COVID crash to the highs in January of this year. So I've got a sneaking suspicion that we may get down to around the 3,200 levels. So we could be looking at up to another 11% decline at the index level. But look, importantly, let's look at the money flows. This is the NASDAQ versus the S&P, and we're now, after a very promising rally, I must say, it's just completely fallen apart again and is in steep downtrend. So that's not looking good. Consumer discretionary versus staples has absolutely fallen off the cliff. That's a lot about Tesla, which does have a significant weighting in XLY, and Tesla has come off the boil a fair bit. And in hindsight, I guess the strength in Tesla was holding this ratio up, the ratio between consumer discretionary and staples. So this up here was probably a bit artificial, and the market is in selling mode on Tesla. Beg your pardon. This is semiconductors versus the S&P. Awful. Just looks quite awful, and a lot of this is because of tensions between US and China and concerns over what that will do to the semiconductor sector and supply chains. Small cap growth, small cap value. The small caps have been a little bit relatively immune, but certainly we got some selling in the last week. This is large cap growth versus large cap value on a weekly chart. We got a nice rally, overshot. All looked very good here in early August, but it's come unstitched again. And finally, this is the Russell 1000 growth versus 1000 value. So not much doubt about where all the intra-market money flows are going. Now, looking at the index, we're continuing to trend quite nicely higher. This is the 50-day moving average, and dips to the moving average are generally providing points of support. And there's quite clearly no real slowing in that rate of ascent. Now, the Aussie dollar, of course, has been copping it, not only because of the US dollar situation, but also because we're a commodity currency, and commodities tend not to do as well in recessions. And you can see we finished down at 61.38 on the Aussie index. So summarising for Aussie stocks, we're still looking at just a tick under 60 on the Aussie dollar, not there yet. Our index was pretty flat, ended up down 0.1% across the week, but look out Monday. I would expect that it'll be pretty nasty on the downside. We had a reasonable session here on Friday because of what happened in the US on the Thursday night, but that'll all get reversed on Monday, I would expect. Now, battery materials, I'll say are vulnerable because they've just gone up so much and there's so much profit in them that they're vulnerable from that respect in the short term, vulnerable to some profit taking. But longer term, the outlook still remains fabulous for battery materials stocks. Precious metals, gold was down by $51, down to $16.44. A bit of US dollar strength effect there, but a lot of that's just straight out selling of gold, which remains out of favour. Because even though gold fell quite a bit, the Aussie dollar gold price only fell slightly because of the currency impact. But all the moving averages are pointing down in gold, as we'll see, so it's not looking too good there. And on the upside, gold is just unable to break through the 50-day moving average, which is pointing down quite strongly. So there's no question gold remains in downtrend. And precious metal stocks is really the same setup as well. I guess the only sunshine you can find in the gold market is that Australian gold miners are making a lot of profit, and that's probably not being reflected in share prices. So that's the gold price. The blue line is the 50-day moving average, and you can see that any little spike rally we've been getting in gold is running out of gas at around about that 50-day moving average, and still pointing quite clearly to the downside. If we look at the weekly, you can see not a lot of difference there. We've broken a key support, tried to rally back above it, but falling away again now. And if we look at GDXJ, no difference there. Unable to penetrate through the 50-day moving average on the upside, and that's an indication that this is still a fairly concerted downtrend. That's the US version of GDXJ, by the way. Turning to other commodities, copper managed to hold steady. Nickel came off a bit, back down to 9.8. But copper's not doing too bad considering. It's the recession fears that the central banks will push economies into recession. That's keeping the pressure on commodity prices, but don't lose sight of the underlying trends. And there's a lot of very positive outlook for so many commodities that really I think they deserve to be a part of sort of future portfolio positioning. West Texas Intermediate crude sagged again, 85.5. It's just all a bit too geopolitical for me. The long term looks good because of the underinvestment, but the day to day, what OPEC is doing, trying to hold the price up, what other countries are trying to do to get the price down to help with inflation, it's all very unpredictable. Oops, sorry, there's the spot copper chart. So we've just really been tracking sideways now for quite a few weeks. Nickel, not a lot different either after we had that huge spike at the start of the year. So the final thoughts, wrapping everything up, and this is pretty much what I said last week as well. When markets are like this, you don't want to be forced into making decisions because you're too exposed, or you're in the wrong stocks, or you're just not certain what's going on, and you're just fearful about where the market might go. So I think the important thing at the moment is you just need to buy some time so that you can assess how this is going to play out. Is this all going to blow through in a few months, or is it going to take longer? And to do that, you need to be positioned accordingly. And there's things that you can do, combination of raising cash levels, doing some hedging, the portfolio composition that you've got now, in my opinion, you should be overweight the stocks that are working well, that are still rising or that are not falling. So all those things can buy you time just to sit back and assess where you go, and then it's a matter of just getting organised in detail. And I've been covering this in the Insiders Club and Portfolio Analyst memberships of late, and I think members have a very clear idea of what I mean by that, to get organised in detail, and it's just a fairly simple sort of process. You just got to spend a bit of time and get organised. Our portfolio analyst last week was just that. We spent quite a bit of time looking at that. There'll be more on that this week. If anyone hasn't been in the portfolio analyst trial, there'll be a good opportunity to come in and see what I mean by that. We also covered a pretty extensive overview of where markets are sitting at the moment. That's it for this week. There's more information on the website. There's my email address, and I'm sure we'll have another pretty highly volatile week, and I'll be back with you next Sunday. Cheers.